So we're continuing our discussion about adjusting entries of revenues and expenses in chapter 3. We talked about we have liabilities and revenue. So in this, we're looking at the unearned revenue. When we have unearned revenue, it means somebody has paid us for cash for service and products we have not delivered yet. So we have a liability. When we change that, so when we are going to record that revenue, we're going to decrease the liability and increase the revenue. So the journal entry for that is a debit to the liability account of unearned revenue and a credit to the revenue account. So we have this example of we received a fee, 60-day fee in advance, covering the period from 12/27 to February 24th. So this is a 60-day period. We earn payment as time passes. So if this is a 60-day fee, as days pass, we earn the fee. On December 31st, we have to record an adjusting entry because we're getting ready to prepare our books for financial reporting, which means that we have to recognize all revenue expenses that have occurred through December 31st. So on December 31st, 5 days of service has been earned. So we are going to do a debit to unearned consulting revenue for $250 and a credit to revenue of $250. So this is our journal entry first, that on December 26th, we received cash of $3,000 for unearned consulting revenue. And then on December 31st, we adjust that, saying that we have earned $250 of that revenue. Okay, so we're looking at the adjusting entry for that, as I said, is a debit to unearned consulting revenue and a credit to consulting revenue. Okay, now we're going to look at an accrued expense. So we looked at this a little bit in chapter 2, where we receive an invoice for an expense that we're not going to pay until the next month. So we have to record the expense as it happens, whether or not we're going to pay for it right away. So if we receive an invoice in December and it says we're not going to pay it until January, we still have an expense that has to be recorded, but now we also have a liability, which means that we still owe money for this bill. Okay, so accrued salaries is a very popular thing, accrued expense, where especially at the end of the accounting period. So as our employees work for us, we earn a liability as a company. So they have given us labor and we owe them money in exchange. So every time an employee works an hour for you, that is an hour you owe them money for. So that becomes a liability until payday when you're going to pay that money. So we have that we pay our employees $70 per day or $350 for a 5-day work week. We pay salaries every 2 weeks, which is fairly common in business, is that paychecks come out every 2 weeks. However, if the year ends in between a salary period, we have to record that we have employees that have earned salaries that we have not paid yet. So on December 31st, it's a Wednesday. 3 days of salaries are owed, which equals $210. So we need to create a liability of salaries payable, which are salaries we're going to pay the next time that we submit paychecks. And we recorded our salaries expense for the end of December. Okay, so we have salaries expense of $210 and then salaries payable of $210. So we look at the difference in that account. So in the income statement, we've had salaries that we paid earlier in the month. And so we show that we had additional salaries expense and that they are currently unpaid. They will show up on our balance sheet as a liability and on our income statement as an expense. Okay. So then when we pay them, so we recorded that accrued salaries, and now it's January, and we're going to pay them. So it's the next payday, and we're going to pay them. So then we have that we're going to debit that salaries payable because we're paying them the money we owe them. So we no longer have that liability. We have additional salaries expense of $490, which is the expense that we've incurred during January. And then we're going to pay cash for our total payroll. Okay. So we have accrued revenues or revenues earned in a period that are both unrecorded and have not yet received in cash or other assets. Okay. So this is when we receive, we do services or sell products on account or on credit. So the asset that we receive is accounts receivable. And we record revenue when this occurs, even though people aren't going to pay us until a later date. So remember, we can recognize revenue even if we haven't been paid, because how we determine if we recognize revenue is whether or not that good or service has been provided to the customer. So even if they're going to pay us at a later date, we have fulfilled the service or the product order. Okay. So we have this accounts receivable where we bill the client for services and they've agreed to pay us in January. So now on December 31st, we have 20 days worth of services that have provided and earned, which totals $1,800. So we're going to do an adjusting entry to recognize that accounts receivable, and we're going to recognize the consulting revenue. So we have accounts receivable of $1,800 and consulting revenue of $1,800. So this is an example of where we started with unearned revenue and it became earned revenue that we still haven't been paid for yet. Okay, so we have accounts receivable that is on our balance sheet then as an asset. People owe us money. And then we have our consulting revenue, which will show up on the income statement. Okay. So accrued revenue at the end of one period results in a cash receipt in a future period. So we have this accrued revenue of $1,800, and then in January they pay us. So in January, when we record the payment, we're going to remove that accounts receivable, recognize the remaining 10 days of consulting revenue, and collect cash for that transaction. Okay, so this is just a rough summary example of what deferrals are and what accruals are, what the difference are between them, and then how we adjust them. So what the adjusting entry looks like, which side of the account gets debited, which side gets credited. So this is just a good example that you can have for a reference when you're working through journal entry. Okay, so we have several examples here. So let's go through each one of them. So on December 1st, we received $3,000 in advance for a 3-month rental contract. Okay, so let's record these journal entries as they. So we received cash of $3,000, and then so that would be our debit. And then we have unearned revenue of 3,000, and that's the credit. I'm just going to use the abbreviation so it fits on one page. Okay. On December 31st, we recognized 1 month of revenue earned. So $3,000 for 3 months is $1,000 a month. So on December 31st, we have revenue of 1,000. We're going to credit or debit our unearned revenue account for 1,000. And then we're going to credit the revenues account for 1,000. Okay. Now we have a payroll. So we're preparing to close our books for the year, and we pay weekly payroll on every Friday. And December 31st is on a Tuesday. Okay, so $2,500 every Friday. We assume a 5-day work week, so Monday, Tuesday, Wednesday, Thursday, Friday. We would take that $2,500 and divide by 5, and that is $500 a day. December 31st is on a Tuesday, so we have 2 days of payroll. So 500 times 2 is 1,000. So now we have a salaries payable. Salaries expense is the debit of 1,000. And the credit is salaries payable of 1,000. Okay, and then this last one here, in 2018, overnight earned income before taxes of $66,750. We have an income tax rate of 40%. As of November 30th, we had recognized income tax expense amounting to $22,608. So this is for recording our yearly income tax, so what we're going to owe for the year. So the first thing we need to do is calculate what that tax expense is. So we have 66,750 and a rate of 40%. So X 40%. So $66,750 times 40% is $26,700. So for the year, we owe $26,700 in taxes. We've already accrued $22,608 of that. So now we need to subtract 22,608 equals 4,092. Okay, so the entry for that is we have income tax expense of $4,092 is the debit. And then we have income tax payable of $4,092 is the credit. Okay. Now, in the next video, we're going to talk about preparing our end of year financial statements and closing out the accounting period.